Everyone, welcome back to your channel. In today's video, we are exploring a crucial topic in finance: profitability ratios. Profitability ratios are essential tools that help us understand how well a company is generating profit relative to its revenue, assets, and equity. Whether you are an investor, a business owner, or just curious about finance, understanding these ratios can provide valuable insights. Let's dive in and learn about the key profitability ratios and how they can inform our financial decisions. So, what are profitability ratios? Simply put, these ratios measure a company's ability to generate profit relative to various aspects of its operations, such as revenue, assets, and equity. These ratios provide insights into operational efficiency and can highlight how well a company is managing its resources to generate earnings. So now let's have a look at some of the key profitability ratios. First, let's look at gross profit margin. This ratio shows how efficiently a company produces goods compared to its cost of production. It's calculated as gross profit divided by revenue. For example, if a company has a gross profit of $50,000 and a total revenue of $1 lakh, the gross profit margin would be 50,000 upon 1 lakh multiplied by 100, that is 50%. This means for every dollar of revenue, 50 cents is gross profit. Now let's have a look at net profit margin. The net profit margin is more comprehensive because it includes all expenses including taxes and interest. It's calculated as net profit divided by revenue. For example, if a company has a net profit of 20,000 and a revenue of $1 lakh, the net profit margin would be 20,000 upon $1 lakh, that is 20%. This shows how much of the revenue becomes actual profit. Now, let's talk about operating margin. This ratio focuses on a company's core operations by excluding non-operational items like taxes and interest. Operating profit margin is equals to operating income divided by revenue multiplied by 100. For example, if a company's operating income is 25,000 and the revenue is $1 lakh, then the operating profit margin would be 25,000 upon $1 lakh, that is 25%. Next, we have return on assets. This ratio measures how efficiently a company uses its assets to generate profit. It's calculated as net income divided by total assets. Suppose a company has a net income of $30,000 and the total assets worth $1,50,000. Then the return on assets would be 30,000 upon 1,50,000. That is 20%. This means that the company earns 20% profit on its assets. Now, let's discuss return on capital employed or ROCE. ROCE measures a company's profitability and efficiency in using its capital. It's calculated as EBIT divided by capital employed. If a company has a EBIT of $50,000 and has a $2 lakh in capital employed, then the ROCE would be 50,000 upon 2 lakh, that is 25%. This means that the company earns 25% return on its capital employed. Now let's have a look on return on equity. Return on equity or ROE is crucial for shareholders because it shows how much profit a company generates with their investment. It's calculated as net income divided by shareholders' equity. For instance, if a company has net income of $40,000 and shareholders' equity worth $2 lakh, then the return on equity will be calculated as $40,000 upon $2 lakh, that is 20%. Now that we have covered the key profitability ratios, remember that these numbers tell a deeper story about a company's financial health. They can help you make informed decisions whether you are investing, managing, or analyzing a business. Thanks for watching. If you found this video useful, make sure to like, subscribe, and comment with any questions. See you in the next video.